Good morning, folks. One and all, let's do this thing on this Friday. Welcome to TheStreet Today here from Post 35 on the floor of the New York Stock Exchange. It is a Friday. Happy Friday, or Fri-yay, as some people call it. Today's the 10th of March. I'm your host, JD Durkin. That's what the box says. We're about an hour or so into the trading session. Stocks are in the red as investors react to the hotter than expected February jobs report. We got those numbers crossing the tape 2 hours ago to the minute. The U.S. economy adding 311,000 jobs in the month of February, ahead of the 225,000 many analysts have been expecting. Let's take a look for what's on tap for the broadcast this morning, my friends. On the show, we will talk jobs as the labor market remains resilient. Plus, we'll break down the market reaction to February's jobs report, and we'll be digging into the Silicon Valley Bank chaos. Yes, chaos indeed, after shares were halted in early morning trading. And finally, we'll tell you why FTX founder Sam Bankman Fried is back in court. For more on these stories and so much more on this Friday, we welcome in our senior editor and our chief markets correspondent, Mr. Martin Baccardax. Martin, happy Friday.
Good morning, mate. Happy for some, less so for others, it would seem.
Why is that? Why is it a less than happy morning for some, I wonder, Martin? Let's start there.
Well, it's a great question. I think to some degree, JD, markets were looking for clarity from the jobs report to sort of separate what their concerns were with regards to growth and inflation, and to sort of properly predict where the Fed was going to be in terms of rate hikes, not only later this month, but going into the start of the year, into the first half of the year. But what's happened this morning is everything has been complicated by this crisis at SVB. So as a result, what you are seeing on the screens right now does not reflect directly what markets are taking from the jobs report, but is an amalgam of what they are seeing with respect to financial risks, the specific concerns that are linked to SVB, and of course, the data that's coming from the jobs report itself. So there is some disappointment in that respect because the markets are simply not going to get the sort of forward-looking vision that they were hoping to have taken from today's jobs report, and as a result, markets are all over the place.
I wonder then, perhaps, Martin, what can we learn from the report itself? We can try and isolate. Let's start with the top line print figure, 311 versus 225. Your thoughts on what we saw there, and then I'll ask you for a bit of an unemployment and average hourly wages breakdown. But to start with the top line figure, your thoughts?
Yeah, I thought it was really solid, and I think when you're over 300,000, I would have assumed that the markets would have sold off very quickly as a result of that, because it would have ignited concerns for wage inflation spirals. But really, that 311,000 was mostly built on the back of service sector jobs gains, and actually wages didn't really accelerate to the pace that people were concerned about. So as a result, you could probably make the case that this is one of those Goldilocks readings that indicates resilience in the broader economy without necessarily stoking further inflation concern. I think that was also replicated by the fact that we only had modest revisions for January and December tallies, and the January number in particular jumps out because it was only downgraded to a gain, I think it was 504,000, which is very close to the 517 that was first printed, and a number that virtually everyone said had to be some kind of fluke or some kind of statistical anomaly. So the fact that the Labor Department is holding firm to that January gain and saying that we added another 300,000 on top of that does suggest that the economy carried a lot of momentum into the first half of the year from the latter part of last year. And that has, without question, sort of raised optimism with respect to whether or not that strength can be carried through into the second half of this year.
And we did see a revision for those January numbers, right? Was it down to 504 or so from 517?
Yes, 504 from 517.
504. Okay, so to unemployment here specifically, rising up to 3.6. The storyline for the last month has been, okay, we're at this multi-decade low at 3.4. That obviously then helps put upward pressure more on wages. What should we take away now that we're starting to see, we don't know if it's a trend, it's at least one data point. We're not at 3.4, we're at 3.6. What do we make of it?
The headline unemployment number, I think, is one that I wish we could consign to history because it doesn't really reflect the kind of indication that we're trying to get out of these labor market reports, because ultimately that headline figure only represents those people who are still in the job market and actively seeking employment. We know that a lot of people have exited completely as a result of early retirement. People have exited as a result of the grim tally of people who have passed away as a result of the COVID pandemic. The number doesn't reflect, of course, the lockdown that we've had in terms of immigration over the last 4 or 5 years in the United States, which has sort of reduced the overall job market itself. So that 3.6% number, whilst higher than the 3.4% that we saw in January, I don't think is any superlative reflection about the strength or weakness in the labor market. I think it's much better to look at those headline gains and the wage numbers that are coming up underneath it.
And Martin, what did we see there with wage numbers specifically for average hourly earnings for February, either compared month over month or what we saw from this time last year?
Yeah, I think it was equally important to the headline gain, JD. Essentially, we saw average hourly earnings rise 0.2% on the month, and that's the slowest pace of gains we've seen since February of last year. Now, on a year-on-year basis, they were up 4.6%, but again, there's some statistics in there that you could probably strip out and essentially say it's a wash, and it's certainly moving to the downside. And I think importantly for those who argue that wages aren't necessarily the principal stoke in the inflation gain, even year-on-year wages are well below the headline inflation rate. In other words, even if we accept that 4.6% figure, it's well shy of the 6.4% number that we know was tallied for January CPI. We'll get, of course, February CPI next week. We may see a downtick in that, but wage gains will still be south of the headline figure, and as a result, it becomes more difficult to express the argument that wages are the principal reason that inflation is at such an elevated level. It's probably more linked to the fact that we're seeing a sort of disruption in energy prices and indeed the knock-on effect from supply chain disruptions and the COVID pandemic. So that wage number, because it was softer than anticipated, offset any concern that people had about the big 311,000 gain. And I would have thought that stocks would have accelerated on the back of that. But again, this SVB situation has just complicated matters entirely.
Let me get your reaction here to what we saw at the bond market. The two-year note is back down to about 4.6% off of its recent high we saw north of 5% a few days ago, after we heard comments from Jay Powell, specifically to the Senate on day one and then the House of Representatives on day two. What other reaction in terms of some of those notes are you following, at least today, that you've seen, either the 2 or 10?
The bond moves are just astonishing, JD. I mean, in overnight trading on Wednesday, when I first began to look at the screen very early in the morning, two-year notes were trading at 511, and that was right after the first day of testimony from Fed Chair Jay Powell to the Senate Banking Committee. So now that we're down to 460, we're looking at a 50 basis point move in short-term Treasury bond yields. That's absolutely extraordinary volatility, and it's something I haven't witnessed for a very, very long time. 10-year notes are also in retreat as well. Again, I think we are looking at a twin component to the drive down. The first is that we're seeing 50 basis point rate hike bets being wiped off as a result of this job print. And maybe as a result of the fact that the Fed might want to rethink whether or not its aggressive rate hike strategy has had an impact on the financial markets. Because if what we're seeing from SVB is true, it certainly has. So we're seeing a flight to quality as a result of people leaving risk markets until they understand better what's happening in the banking sector and around the regional banks in the United States, which are all trading lower. And we're also seeing a repricing of interest rate risk. Both of those components are driving Treasury bond prices higher and yields much lower.
What do we see with regards to CME Group's FedWatch number? Obviously, it went very high in terms of the possibility for 50 basis points for the March FOMC meeting. Last I saw, it started to kind of come back down to earth, but what do we know now about what might happen or might be expected to happen, I should say, for the upcoming meeting after today's figures?
It looks all over the place at the moment, JD. I saw it essentially after Powell's first day of testimonies to the Senate Banking Committee. The number raced to about 80%. In other words, people were almost entirely unanimous in their betting that the Fed would increase its rate hike to 50 basis points when they conclude their two-day meeting on March 22nd. It began to ease back after the second day of testimony when Powell seemed to mitigate some of his commentary by saying the Fed is going to examine the totality of data going into the Fed meeting. Now, it had collapsed completely to about 24% in the early trading this morning after the jobs report and in the wake of the SVB situation. The last I saw it, it was hovering around the low 50s mark. So it seems to be a coin toss as to whether the Fed is going to go 50 or 25. But unless we have a red hot CPI data next week, I cannot imagine the Fed taking the risk of going 50 if they have any concern about the weakness that we're seeing in regional banks and potentially in the banking sector as a whole. I'm also seeing, JD, bets reduced on the terminal Fed funds rate as well. Very few people are talking about 6% now. 5.5% seems to be the top, and it's falling even as we speak right now. There had been some small bets this morning about a potential rate cut at the end of the year, but I think they're too insignificant to really give much attention to.
I was going to say, my goodness, we're back in the land of potential rate cuts already, even if it's just a few voices. My goodness. To go back a few days ago, something you and I talked about, the exchange with Senator Elizabeth Warren with regards to the number of Americans that would actually be out of work if the Fed's intended goals of kind of raising unemployment. I believe the figure that the senator cited was 4.6% unemployment based off the Fed's guidance from before the calendar year. As far as you know, is that still more or less the target for the Fed to help kind of help put today's 3.6 number into a bit better long-term perspective? Is it still about 4.5, 4.6, you think, that the Fed is more or less shooting for?
At least on the basis of the last Fed projections, which were published after the interest rate decision in December. We'll get a fresh set, in point of fact, later this month from the Fed governors, and those dot plots will give us a better understanding of where the Fed sees the terminal rate, where it sees inflation accelerating between now and the end of the year, and perhaps most importantly, what their prediction is for the headline unemployment rate. But you're right, it does stand at 4.6% right now. It may be tweaked as a result of these better than expected job gains in January and February, or indeed it may be even increased against the assumption that the economy might tip into recession over the second half of next year. But you're right to point those numbers out because they'll be very closely tracked by markets alongside the interest rate decision itself.
Martin, what do you think we are not paying close enough attention to in this conversation? Be it Fed, unemployment, prices, wages, whatever it is. What are we kind of missing?
It's a great question. I mean, my mind, at least this morning, and it's probably recency bias as a result of what we're seeing in stocks and bonds linked to the SVB situation, is that we're looking at unknown unknowns, to steal the phrase from Donald Rumsfeld, the former defense secretary. At present, we're having a better understanding of where the Fed rate hikes are affecting the economy. We're seeing it show up in the data, and we can understand that on a month-on-month basis. That said, what we don't know is probably what we most fear, and that is where the underlying pressures are beginning to bubble up as a result of this extremely aggressive Fed rate hike. Of course, this time last year, JD, we were at 0% on the Fed funds rate, 0 to 0.25% effectively. So we've added 4.5% to that in a very short time with big aggressive rate hikes. In parallel to that, JD, the Fed started to roll off the balance sheet from which it keeps mortgage and treasury bonds. So the market has had to absorb incredible central bank tightening and take down 50 to 60 billion in bonds every month alongside that. That simply doesn't come for free. And we don't know what the cost has been to the financial sector. But because now we're starting to see some concerns bubble up in the banking sector, we are now wondering where the next pressure points lie. So if you ask me what we're not paying attention to, I think the fact is what we're not paying attention to cannot be seen just yet. And that is really what's worrying markets and a big reason why we're seeing such a retreat in risk appetite.
No, I appreciate that reminder of the QE and QT side of things does not perhaps get talked about as much as the other flashier stuff like interest rates. I can't believe I just called interest rates flashy, but you know what I mean, right? It's something we talk about much more. That's how cool I am, folks. Yeah, it's very, very flashy, very cool, exciting topic of raising short-term interest rates. But that shows you kind of... Yeah, oh, absolutely it is. Okay, so let's talk about SVB. My goodness. Silicon Valley Bank here tumbling over 60% in pre-market trading. Shares are halted earlier today. Martin, Deep breath. What is happening?
This is absolutely amazing, JD. I tweeted this morning that 3 days ago, Silicon Valley Bank, which it does business as, had a conference call with investors where they were tweaking some of their forward projections for their profits and sales. There wasn't a single mention of the word deposit. That was 3 days ago. Today, we're looking at an absolute collapse in the share price, a 60% decline yesterday, the most in 2 decades, and a further similar percentage decline today, one assumes, once the stock resumes trading. It's hard to pinpoint precisely what happened, but essentially, Silicon Valley Bank is a lender to tech startups, and indeed keeps a lot of deposits from those startups on its balance sheet. Because that venture capital market has been essentially frozen for a number of months now, no IPOs, no big deals, SPACs disappearing the whole bit, we're not seeing a great deal of cash flow as a result in terms of profitability into SVB. Now, at the same time, SVB, like a lot of other banks in the United States, held a great number of US Treasury and US mortgage bonds. They do that to protect their balance sheet from potential losses on the assets that they own. Now, because we've had such a significant spike in Treasury bond yields, the value of those assets on the portfolio have fallen significantly. SVB had to take a loss on the sale of a portfolio. It was tabulated at around $1.8 billion. So they were going to do a capital raise in order to plug that gap. In between the launch of the capital raise and the announcement of it, people began to pull their deposits from the bank over concern for its financial strength. And this can happen to any bank virtually at any time. Once trust is eroded and deposits flee, it's an ever downward spiral. And that's precisely what we're seeing here right now. I'm also seeing reports, JD, that the capital raising has failed and SVB may need to sell itself to a financial buyer. But financial buyers don't want to step in if the deposits are fleeing and the asset value is eroding. They want to wait and see where the bottom is. And of course, that can be self-fulfilling to the downside as well. So we may not know ultimately the fate of SVB for a number of days, but as a result of the concern that people are having for the banking sector, we're seeing stocks all over the place halted as a result of volatility to the downside. Most of them regional banks, and many of it linked to the fact that they're all sitting on billions and billions of dollars of treasury bonds, which have lost billions and billions in value as a result of the Fed rate hikes. So that's a great example, JD, of an unknown that wasn't really given a great deal of attention just a few days ago and is now jumped to the forefront in terms of financial market risk.
I really appreciate the context for that, because I'm sure there's a lot of people waking up today saying, I've maybe not even necessarily heard of this in particular bank, nor the impact on some of the regional names that you just went through. So give me your sense for people wondering why this might spook Wall Street as a whole so much. Keeping in mind, of course, your very first response of the day said this is not mutually exclusive from reaction in terms of the jobs numbers today.
Yes, exactly. Ultimately, JD, I mean, everybody has PTSD with respect to banking sector risk because in large part, it was the trigger for the global financial crisis in 2007 and 2008. So really what you're looking at is, discretion being the better part of valor. Right now, investors are just not willing to take a risk in the financial sector as a result of what they're seeing at SVB until they get a clearer picture. And it's interesting to me, JD, about a month ago, there was a very sort of unrecognized report from the St. Louis Fed that warned of the potential risks for unrealized losses in a lot of regional banks and indeed larger financial institutions as a result of the billions in treasuries that they're holding on to. We didn't pay much attention to it, myself included. It didn't turn up in any of the research notes that I've been reading since then. But now it's on the front of everyone's thinking as a result of what we're seeing from SVB's balance sheet. And I think that is probably why we are seeing such a retreat in terms of risk assets. And the best place to go in those situations, JD, is the short-term and mid-term bond market. And that's why you're seeing such an elevated price spike and a corresponding decline in yield.
Do we know the impact on other banking names as a result of what we've seen here with SVB?
No, and to be honest with you, JD, I wouldn't want to speculate because that's the kind of reporting that can be self-fulfilling to a certain degree and cause bank runs. And I think to some degree, there's a level of responsibility that we all have when we talk about banking sector health. I can tell you the names of bank stocks that were halted for downside volatility, but in no way, shape, or form do I want to suggest that they have the same financial stresses as FBB, as SVB. The only thing that I can say is that the St. Louis Fed research report did say that the amount of treasury bonds that the banking sector holds is about 5% higher than it was prior to the pandemic and represents about 25% of collective banking assets. So it is a significant and real risk across the whole of the sector, but it's almost impossible, at least at the moment, to pinpoint names that might be under pressure as a result.
Is there any way by which raising interest rates or rising interest rates are playing into this as a story for people watching, saying we cover one story so closely, now we're highly focused on this other? What's the link, people may wonder?
They're absolutely interconnected. The Fed's twin mandate of price stability and full employment and the blunt instruments that they have on their panel essentially force them into these rate hikes. Now, many people said they should have gone earlier, and therefore, as a result, they could have had a more gentle slope in terms of the rate increases. But nonetheless, they did have to tighten, and they did have to tighten financial conditions very quickly because inflation simply accelerated faster than anybody had anticipated. And the consequence that we're seeing now is the fact that it's affecting bank balance sheets, most specifically with SVB, and as a result, it's going to tighten further financial conditions in the months ahead. And that, of course, is likely to lead to a pullback in credit, potentially a pullback in lending to small businesses, very likely in the tech space. And that has knock-on consequences for economic growth.
Martin, any guess or thoughts about what happens next for the bank? Dare I ask?
Impossible to say. It's really complicated. I do apologize. I'm going to turn that off. It's really complicated to assess simply because we don't know where the bottom is in terms of the deposit base or what happens to the assets that are sitting on SVB's balance sheet. The Fed might have to come in and rescue the bank. It may have to rescue depositors. A buyer could be lined up, either foreign or domestic. Private equity buyers could come in and try to buy the assets in order to make sure that their investments in tech startups aren't sort of eroded by the contagion of the SVB fallout. So there are, I think, multiple scenarios in which this could end up being unwound. But at the moment, I just don't think anybody wants to commit the capital to do it until they know where the bottom is with regards to SVB, and we're just not there yet.
Absolutely. Well, Martin, thank you for being willing to dive into all of that. It's obviously one of, if not the top story of the business world right now. It has been for the last day or so, and may continue to be as the fallout continues, and which means we will continue to track it. I'm very thankful for your context and perspective on it. Okay, folks, time now for our rapid fire section, the last one of the week, because it's a Friday. First up, let's talk Oracle. Reply hazy, try again. Oracle reports mixed Q3 results. What are the details there?
I like it. Oracle beat on the top line, on the bottom line by about 2 cents. I think earnings came in on an adjusted basis at $1.22, but they were a little light on revenue. And when people are pulling back in risk, Oracle was always going to get caught in that downdraft. They were actually reasonably bullish near term, and they see profit and sales growth that was above street expectations for the current quarter. That's probably good news for the cloud space, where Oracle is starting to gain market share and really act as a bit of a disruptor, which is a weird thing to say for a company that has such pedigree, but it has only recently moved into that cloud space. It bought a medical records company last year called Cerner. They hope to add more healthcare customers along the way. That's going to boost profitability as well. I think investors looking for an entry point into the cloud space, if they are indeed as optimistic as Oracle, could look no further than this stock. It's probably not going to be on sale very often, but it is so today.
Absolutely. Okay, number two, mind the Gap. Shares of Gap slump after a wider Q4 loss. Give us the breakdown there, Martin.
Yeah, weaker than expected holiday quarter sales, and then as a result, we had a steeper than expected loss. I think it was about 76% on an adjusted basis. And if by memory I am correct, sales were down by about 6 or 9% to about 4.24 billion. Still a healthy top line, but margins are being compressed as a result of some discounting and right sizing of the inventory. And we've seen that across the spectrum of retailers. But they had a muted outlook. I think there is the anticipation of a consumer spending pullback in the coming months, and therefore Gap got caught in that downdraft too. They also got rid of a few executives, including the CEO of their Athleta brand. That didn't really engender a great deal of confidence. So investors are pulling back from that stock. But it's always a whippy one in and around earnings. So I'm not surprised by the downturn. I think it was about 8 or 9% when I last looked. But the numbers just simply weren't great, and the company does continue to struggle to execute.
All right, third and final, Mr. Bankman Fried heading back to court. What happens next here, Martin? What should we know?
Yeah, I mean, we're still looking at what is going to come out of the bail conditions, particularly since the government has sort of increased the charges against Sam Bankman Fried for the collapse of FTX and the fact that there appears to have been commingling of customer funds into the Alameda Research hedge fund and some of the risky bets it made and risky loans it made in the crypto sector. We don't know precisely what the outcome is going to be, but the suggestion is that Mr. Bankman-Fried will probably only be allowed to have a very basic flip phone because of concerns about him contacting ex-employees of the company. Bankman-Fried's lawyers are arguing that they actually don't know how the case is being built against them, and they haven't received records from various ex-executives who are now cooperating with the government's case. So this, I would imagine, will go back and forth. Mr. Bankman-Fried will probably remain free on bail, but if he were to sort of go against any of these new strict conditions, his freedom could be a question in the months ahead.
Yeah, incredible story, and also one we will continue to follow, as we will all of the stories we covered this morning and all of the stories that Martin helped us better understand on this Friday. The great Martin Baccardax, thank you. Enjoy your weekend, my friend.
Thanks, JD. You too.
You got it, man. We'll see you next week, brother. All right, folks, that's going to do it for The Street today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. Have a great Friday. Have a great weekend, and we'll see you on Monday.